There's some weird stuff that happens in private companies.
Yeah.
This stuff is always at the peak of when there's a correction, right?
Correct.
I mean, this may be a good segue to talk about what's going on.
It's a great segue.
But it's like that level of grift happens right before, basically we have to re-rate valuations.
To solve the problem.
Because entrepreneurs just take so much. Well, there's just a small percentage of them, but they just take so much leeway in pushing the boundary. And
sometimes it's other board members who are acting in their own interest. But I solved this problem really easy. I called the CEO of the public company that was buying them and explained the situation. He's like, talk to my CFO, I'm a fan of the pod, whatever. And they said, how do we solve this with you? I said, well, this is how much money I have in. This is the value of your company. How would you like me to be an advisor to your company for the same amount of that value in shares?
Oh, so you grifted.
So, no.
That's great. So basically, you got bamboozled. And so you bamboozled everybody else by letting them be the bag holder.
And then they said, okay, we'll make you an advisor. Then I took the advisor shares and I wrote a letter and pledged them to my investors. And my investors are now 3x their original investment. And I said, I'm not letting it go. I'm not signing the paper until I get the $250K that my investors put in, period. And then they did it. Now I'm up. All right, let's segue. Crazy market pullback. The great write-down has occurred. Charts from Altimeter, our friend Brad Gerstner, I assume, show a major regression to the mean for tech stocks, SaaS index, median enterprise value, next 12 months, expected revenue, yada, yada. This includes people like Adobe, Datadog, Shopify, Twilio, Workday. And as you can see here on the chart, which we'll pull up, Sacks, explain to us what's happening here.
Well, it's a major regression to the mean on public company valuations in both SaaS, but also more generally. The high growth stocks have corrected more than the indices. So that would imply that there might be more correction to come against the indexes. I think the growth stocks have already taken the bulk of the hit. But what triggered it this week is, I predicted, and you guys had similar predictions just a few weeks ago, that this would be, 2022 would be the year of the correction. And it really began in November. You had the Fed. You had Fed governors make some hawkish statements about inflation not being transitory, about the need to raise rates. Then we had the Fed Open Market Committee meeting. This was I think around December 15th. And they announced what they were going to do on rates. And now this week, the minutes of that meeting were released. And it basically, it said something that was completely different than what they announced to us just 3 weeks ago. And so the market basically just seized up and went into convulsions. And specifically, what they said, in mid-December was that they were going to taper faster. They were going to end they were going to end QE at the end of Q1 instead of Q2. And then we're going to have quarter point rate hikes in Q2, Q3, Q4. That was the plan for 2022. And then there was additional guidance that they were expecting 3 more quarter point rate hikes in 2023 and 2 in 2024. So that was sort of the 3-year plan that was laid out. Then we find out from these minutes, and I guess these minutes weren't leaked or anything. They published them after a 3-week revise and extend remarks type period. But what we find out is that what they were talking about was having a rate hike as soon as Q1 and not just ending QE, but actually shedding assets, which is like the opposite of QE. So instead of basically going out there and creating money,
shrinking the balance sheet.
Yeah, shrinking their balance sheet. So instead of going out and buying bonds, they're going to sell their bonds, which will reduce the money supply. So look, if that was their view 3 weeks ago, why didn't they announce it? I mean, my problem with this is it makes the Fed look like they don't know what they're doing because they announced something just 3.5 weeks ago that's completely at odds with the statement they just put out. So either something changed in the last 3 weeks and there's been no data, or they don't know what they're doing.
Just so you know, they have a little bit of a track record of this. So in 2018, it looked like there was going to be inflation, and Powell tried to get ahead of it, and he raised rates, and the market completely collapsed. And they were looking, I think, at Chinese data at the time, and it looked like China was turning, going crazy. Then China completely turned over. It was a complete head fake. The economy wasn't rip-roaring. Inflation didn't exist. And they basically just curtailed a lot of investment and destroyed a bunch of value. So this time around, I think they're very sensitive to not correcting too quickly. But then the opposite thing happened, which is they probably waited a little too long. And now, we're correcting too slowly, too late into the cycle. And we're just sort of digesting that reality. And so I think that, we're probably, to be honest with you, actually we've puked it all out for the most part, in my opinion. You have to remember, right? The big difference between now and even 10 and frankly, more importantly, 20, 30, 40, 50 years ago is how many computers are involved that trade, how much passive money is involved that owns assets, and how much of this stuff is sitting on the sidelines still in money market accounts and munis. So if you look at those markets, there is a ton, trillions of dollars waiting to find a home. And what we've now done, and Brad's charts show this, is we've basically chopped the head off of all of these fast-growing growth multiples. The underlying companies have not changed one scintilla, right? These companies are still growing by crazy amounts. Like Snowflake is still an incredible business.
Unbelievable.
But the multiple that one was willing to pay has been very much re-rated, as is a bunch of other companies.
So let me ask you a question, Chamath. If we've gone from these 50, 60, 70 multiples times sales, and now it goes back down to 20, is that, dare I say, a buy signal? Well, and will those trillions of dollars start moving back in? Because who wants to be in a money market?
I don't know, and I can't really call these things. But a really smart person that I talked to this week, he actually liquidated everything in October and November. And and I don't know. We talked about this on the pod, but I was feeling so much tension at the end of last year. I actually, when I look back on Q4, it was probably the most difficult quarter of my professional life in just trying to manage risk. And I exited a ton of positions. All my pipes, my third-party pipes, I basically sold off except for one. I generated some liquidity in other places as well. And I was glad that I did that, in part because I saw, what he was doing, and in part because, Jeff and Elon were selling. And I thought, this is crazy to sit on the sidelines and, be the bag holder here. Going into Q1, I talked to the same guys, and what he said to me, which I think is very smart, is you have to really look at the first and second derivative of the 10-year bond. Because when that stops moving, the 10-year bond is this beautiful barometer of the collective wisdom of every single investor in the world about what they think about long-term growth and inflation. And it's a really important market. We've talked many times. Look at the 10-year break even if you want to understand where inflation is going. We started to talk about that 7 months ago. And if you look at that, the rate of change, so the volatility in the 10-year yield is slowing way down. And if that continues to hold, that means that people are really saying there's a small amount of real inflation, a reasonable amount of transitory inflation, and we're about to kind of wash most of it through the system with, 100 basis points of rate hikes. And if that's the case, then you may see a quick pullback, in Q1, and we're back to the races again because of all this other money that's going to say, I got to get back in. And if you look at all these corrections in the world of computer traded algorithms and ETFs and passive money, and it's all, the snapbacks are so fast. You correct 20% and then whoop, you whip it back and you go. So I don't know. That's one view based on the past. But
when you have these big swings, remember, it's not that every issue moves perfectly in sync with every other issue. So there are these, call it over adjustments that happen within a cohort. So within a group of companies, some of them will trade down much farther than others. The multiple will compress much further than others. And there's certainly opportunities within, as there is in any market that's moving quickly, to find businesses that now are priced as mature, non-growth value businesses, and they're profitable and growing. And there's a bunch of those out there now. And that wasn't the case a month ago.
I don't think a single thing in the last quarter has changed in the underlying fundamentals of the majority of businesses that are public. And I actually think, for the most part, nothing has really materially changed for the majority of private companies. All that's changed is what you're willing to pay in the future for it. And the one thing that hasn't changed is what you're willing to pay in the future for the private businesses. So the real question, for Sacks and, for the active investors in the private markets, which I don't know what to think about, is will the haircut that we've all taken in the public markets spill into the privates? And
it's starting.
But it feels to me, it's not just about what's going to happen with new emerging growth companies. But you guys correct me if I'm wrong, but there are hundreds of companies that have raised billions of dollars at valuations that if they look in the public markets now, they are never actually going to achieve if they were to go public in the next 3, 4, 5 years based on their projections.
So to your point,
so
there are 900 unicorns right now. 900. And so once you get to, look, it's one thing to be a $200 million company and sell to Microsoft or whatever. But when you're a $1 billion company, there are very few buyers.
And I just want to point out there's a huge disincentive for an investor or a shareholder, a VC or a private equity firm, to take a big write down on a company like that. And so there is always this push to what do we do next? And it creates this certainly, I
can
mean,
tell you, yeah.
I'd love your point of view, but this really like unhealthy tension, because to take a write down on 900 unicorns is going to cause a write down of hundreds of billions of dollars across all VC portfolios in aggregate. Because they're not going to end up going public at,
sorry, just to finish your thought, because the end market is only to go public. There are very few companies.
There are no M&A exits. Yeah.
There are and not in the billions of dollars, because you have to think big tech is off the sidelines. Okay.
Yeah.
You know, even if you look at like Visa and MasterCard,
they're not going to be allowed to do big deals.
Nobody's allowed to buy these big companies.
There'll be mid-tier M&A. I have an example that I can tell you.
Mid-tier maybe, but my point is when you have 900 companies worth $1 billion and plus,
they have to go public.
And so you can't go public into a valuation framework that values you at 30 to 40% less of your last private mark.
Right.
Yeah. That doesn't work. You did have...
Or do you, Chamath?
You actually do.
So this is an important question, because isn't that going to be the case that all these VCs with the 2015, 2016, 2017, 2018, 2019 vintage are going to end up having... They've all got these great marked books right now. You know, the books are all marked to 3x, multiple on invested capital. And now they're going to end up having these liquidity events that are going to come in at shockingly low valuations. And there's going to be this great write-down and retrenchment.
I can tell you there's a couple of examples. One is The Athletic yesterday, which had raised money at $500 million just 2 years ago, just sold for about $500 million to the New York Times. And those investors basically put money in and they got their money back. It's a push. So I think you're going to see a lot of these pushes. Point. No, I'm agreeing with you. Yes, I'm going to give you the examples. Then there's also
mid-tier acquisition by a mid-tier acquirer.
And so there'll be plenty of those that occur. So there'll be a lot of pushes, I think, is my prediction of those 900 unicorns. And then for a lot of these SaaS companies...
So you're saying you think that a bunch of them are going to sell for under $1 billion, and the VCs, because they have preference, they're going to get their money back?
Correct. I think it's going to be a lot of these pushes where, I don't know, what is it in blackjack, David, when you're playing those three hands and you get a push? And it's like, okay, I'm going to live to fight another hand, now which we've seen Sacks do a number of times. And then for the SaaS is where Sacks, I'm interested in your position, because we saw in SaaS, all of a sudden, the private market, 30, 40, 50, 60, 70 times top line. And now it's gone back down to 20, 30, 40. So those companies now basically have three.
The public markets have, but I don't think the private
markets
have.
It has happened already. Everybody's pausing. And so for the people who raised that 50x, congratulations, you did the right thing. If you have enough money to fill in that valuation.
Is it a congratulations though? I mean, it seems like they're in a pretty tough position now. You just raised money at $1 billion valuation with 10 million of revenue. You're like,
or 20. Let's say 20 would be the more likely.
I mean, like, what are you going to do? What are you going to do in your next round? Because you're burning 100 million a year now, or 40 million, or whatever it is you're burning.
Almost all the companies I've seen in this exact situation you're talking about have that 20 million. They got $1 billion. They raised 100 million or 200 million, and they're basically now saying, okay, we got to make this last until we can catch up to that valuation and get to 50 to 75 million. So I think I would take that deal as a founder and as an investor, because it takes out the downside, and now you just have to worry about catching up to the valuation, and you have 4 years of runway. They're not going to. They're going to right-size the spending.
No. Those companies do not. Those companies absolutely do not have 4 years of runway. I will bet dollars to donuts they have 2 years or less, and most of these companies have 18 months.
Which means they got to be raising in 6 to 9.
No, they're changing. They're changing their spend, and they're changing their targets.
How are they changing their spend? They're not firing anybody. You're not hearing about layoffs at startups.
Okay, all right. You're not hearing about it, but maybe they're changing their forward-looking growth plans. What are you seeing, Sacks? I'm telling you what I'm seeing. What are you seeing, Sacks?
I think that the trickle-down effect is inevitable, but I'm not sure it's fully kicked in yet. It's going to take a few high-profile deals to land at, say, 50 times ARR instead of 100 times ARR in order for everybody to know that there's a new valuation level. So if you look at the altimeter chart on public SaaS multiples, let's see. I mean, Nick can pull it up. It's the SaaS index. It shows median expected value to next 12 months revenue. And during this sort of late 2020, early 21 period, it got as high as about 15 times the historical
next
average.
Year.
Yeah, for next 12 months revenue. Which is sort of, that kind of makes sense. So historically it's around 8, right? So basically all the valuation levels doubled and now they've come down to about 10 times. So you could say that if it fully reverts to the mean, we still got like another negative 20% to go. I don't know if that's going to happen. I mean, I think there has been a greater recognition that SaaS businesses are some of the best businesses to own, right? They are subscription software businesses, great gross margins. They just keep compounding. So maybe it will stabilize at 10 times. But I think what we can say with 2020 hindsight is that the record price levels we got to in the public markets in 20 and 21 were sort of unusual and unique, and probably the result of this incredibly expansionary fiscal and monetary policy that was coming out of Washington. Now, has it trickled down to again, VC markets yet? I mean, the way that has to happen is that the latest stage investors, the crossover investors who invest in both public markets and private markets, they have to start paying less for the latest stage growth companies. And then, all the downstream VCs are going to start paying less as well because, if the markups are lower, you have to take that into account. So look, all of this is underway right now. I mean, I gave a Bloomberg interview in December, and I think I went on Maria Bartiromo's show around that time as well, and I kind of warned that all of this was coming. And we're in the midst of a giant re-rating because we're realizing that so much of the peak values we were seeing in 2020 and 21 were the result of artificial liquidity. And it's what you guys predicted. It's one of our big, I guess my big prediction for business losers this year were asset classes that were highly dependent on liquidity. You guys predicted crypto would be one of those. Clearly, it's taken a massive hit. Have you seen how much the crypto markets are off just in the last week? So it's
so much for them being uncorrelated.
No, it's highly correlated. Look, the crypto markets.
Saying Bitcoin's going to be uncorrelated, so the market's going to go down.
The crypto markets are like a sponge for liquidity, and the more liquidity there is out there, the more money can flow into a more speculative asset class. But look, my objection to this, is that if you look at the Fed's actions, I think Chamath is right that they waited way too long to react. And during the crisis, they overreacted. They pumped. We on a previous pod, we showed the assets.
They vacillate between underreaction and overreaction.
Yes, exactly. Yeah. And now they're going into overreacting again. Yep. I actually think they nailed it in mid-December. They nailed it by giving us business certainty around what the new rate environment was going to be. And just 3 weeks later, in the minutes to that very meeting, they completely undermined the certainty or the greater level of certainty and predictability that they had provided markets. They've now introduced massive uncertainty. So it's unbelievable.
It's like they're pilots and they stalled the plane and then they're like, oh, let's pull back.
Well, no,
stall it some more.
They're kind of pulling out the manual and learning in real time.
Yeah. And it's like, you need to just point the nose down a bit and add a little bit of speed so you get some lift. It really is tragic. The
performance of our government at every level since COVID at the last, since 2020, it's been abysmal. First you have the self-inflicted wound of lockdowns. The economy was going to take a hit no matter what because highly at-risk people would have stayed home and reduced their economic activity. But instead of just protecting the at-risk people, we had to lock down the entire economy. We padlocked Elon's factories and on and on. So we basically shut down the whole economy for no reason. And states like California kept it going way longer than they had to. So then the government just prints like 5-6 trillion and the Fed doubles the size of its balance sheet. And overnight. Then now they're abruptly getting off drugs. Look, they put us on drugs and now they're going cold turkey. And so I think there's actually a much greater risk now of the economy going into recession this year because of the Fed's overreaction this week. They had the Goldilocks scenario down about 3 weeks ago, and I think they're going to tank the thing now. Or there's a much greater risk of that.